So George, recently we spoke around the teacher's pension, the benefits, any potential drawbacks, complexities.
Mm-hmm.
Today I'd just like to touch on alternative investment and retirement planning options for teachers. So, let's think about, the different types of investments, whether it's bonds, whether it's investment funds.
Mm-hmm.
Kind of over to you. Let's spend a few minutes kind of just chatting about that.
The benefits of the teacher's pension scheme in terms of that generous employer contribution, in terms of all those guarantees,
Yes.
there's nothing out there that is going to be better than that. But don't confuse it being really, really good with it being the single answer to everything.
Yeah.
So I'll give you a couple of examples. A lot of teachers plan to retire at 60 because the older version of the scheme had a normal retirement age of 60, and that's the line that's drawn in the sand.
Okay.
But changes to state pensions mean that most teachers now won't get their state pension till age 67, 68.
Mm-hmm.
So if you were to sort of draw your income as a graph, you've got all these years where you've got, your salary coming in, you're doing well. And then the point at which you retire and you start your retirement, and your youngest, fittest, most active years of retirement, when you've got the most enthusiasm to go out and see the world, are going to be your poorest, your lowest income. And then you've got, 7 or 8 years, and then your state pension kicks in, and then that carries on up with inflation. So we've got this kind of void. So good advanced planning might be to say, well, I know I want to retire at 60.
Mm-hmm.
I know I'm not going to get a state pension till 67, 68. Okay. How do I plug that gap?
Yes. Yeah.
Now, there are options within the teacher's pension scheme. You could take a lump sum, but then that's going to reduce your income.
Okay.
So would it be sensible to build up some other forms of more accessible capital? Okay. Now, whether that be a personal pension or an ISA or various other things is very much an individual decision based on your tax position and your personal circumstances.
You can access part of your pension at the moment when you're 55, can't you? Which
correct.
Yeah,
if it's a personal
and then
pension,
obviously things like ISAs, you can put the money in, you can take it out. There's no penalties kind of for that. It's tax-free growth.
Yeah, well, the penalties depend on the individual provider, but if you want one without penalties, then they're out there.
Yeah, that's fair. That's fair.
Also, think about what you want your retirement to look like.
Okay.
So there's an exercise I get any client to do when they're starting to gear up for this transition into retirement.
Yes.
The first part of this is to write down a really honest list of what you spend. So when I say honest, I don't mean like the one you write when you're applying for a mortgage and you pretend you never spend anything. This is only for your own reference. So all the essentials, paying the bills, paying your council tax, keeping food in the fridge, etc. And also the fun stuff, the holidays, the travel, the leisure, the meals out, the time with the family, whatever it is you do for fun. Yeah. So write a really honest list and then think, okay, if I retired tomorrow, how would this list change?
Okay.
So I'd spend less on commuting, for example, if you're currently driving to and from school and you're not going to be doing that anymore. But I might spend more on holidays, on leisure time, because if you're anything like me, I'm only in 3 modes. I'm at work or I'm earning money. I'm not at work and I'm usually spending money, or I'm asleep. So if you get rid of the earning money part, you've got, 7 days a week of holiday. So how much would you like?
Of course.
Well, exactly.
There we go.
A lot more of that if I could retire as well. But so think how would it change?
Yeah.
And then divide all of those things on the list into 2 columns. The first column is essentials, the stuff you have to do if you're just going to stay alive.
Yeah.
And column B is your quality of life. So column A is gas and electric and water and council tax and food and haircuts and insurances. And column B is holidays, travel, meals out, leisure time, hobbies, all of those sorts of things. Mm-hmm. Then think about how those 2 figures, if you tally up those columns, how will they change over time? So column A, the essentials, 2 things we know. Number 1, you will always have those bills to pay. Okay. If you live till 112, you've still got to pay the gas bill, you've still got to eat, you're still going to have to pay your taxes. And number 2, we know that those bills will go up every year because they just do. That's what inflation is. Yeah. Exactly. So in an ideal world, you would want a source of income that's 1, guaranteed for life, and number 2 will go up with inflation.
Yeah.
So that's where, your state pension is perfect for that. Your teacher's pension is perfect for that.
Yes.
And so if we can cover those bills from a guaranteed income source, then, it doesn't matter how long you live. If we as a species, crack the cure to cancer, heart disease and stroke, that's what kills. You don't die of old age. You die of some kind of illness, typically in old age. Yeah. So, it's going to get more and more common for people to be living into their 90s and, getting their telegram from the king and beyond. So it doesn't matter how long you live, your bills are paid.
Yeah.
But this column 2, the quality of life stuff, my experience tells me, because I look after clients in all different stages of retirement, when you first retire and you've got all this free time and all this bucket list to tick off, that's when you're going to want to go on the safari and the trip to Vegas and the around the world cruise and just do all this stuff. Then when you're in your middle years of retirement, you're sort of in your 70s and approaching your 80s, guess what? You're still doing that stuff, but you're slowing down.
Okay.
So it might be a bit more cottage in the Cotswolds and a little bit less bungee jumping in New Zealand. Maybe, and not
Both
judging.
of those sound nice, but
Exactly. By the time
one sooner rather than later, I would have thought.
That's the norm. That's the norm.
Yeah.
By the time you're 93, you're probably sitting in your armchair, pottering around the garden. You might pop to the shops.
It's not bungee jumping in New Zealand.
Fewer 93-year-olds than 63-year-olds.
You know.
So if you think about how that kind of expenditure is going to look, it's probably going to start off high and it's going to taper down.
Yes.
And at the end, unless we start talking about funding long-term care and that, which is a different conversation entirely, you're going to want less of it. So I often use my nan as an example. She was 93 when she died. And for her final 5 years, she really didn't leave the house. And she had money pooling in her current account. Now, if we could have taken that money, put it in a time machine and whizzed it back to when she and my granddad first retired, they could have definitely thought of something to do with it. So back to how this applies to teachers' pensions. Your teacher's pension, albeit it's guaranteed and it's reliable, it's rigid. You get the exact same payment every single month for your whole life, other than inflationary increases. So you can't say, well, I think I'll need less in my 90s. Can I have more in my 60s? But good financial planning allows you to do that. So if you've built up the foundation of your teacher's pension and your state pension to pay those essentials, but you've built up some wealth outside of that, that you can then use to enjoy those early years of retirement, particularly those years between stopping work and state pension age, if you choose not to work up to state. But even beyond that, then that's going to enable you to have a much more enriched and fulfilling retirement, whatever that means to you. So whether you want to travel the world or just spend time with the grandkids, whether you just want more, theatre tickets or whatever, more time on the golf course, whatever it is that excites you and, enriches your soul, if that's not too hippie, to be able to do those things. So the teacher's pension is less flexible. It's guaranteed. It's rock solid. It's robust. So good financial planning says, well, we want that as our foundation, but also I'd like to do this, this, and this. I'd like to clear my mortgage at 60 or 55 so I can retire. Teacher's pension won't do that unless you strip a lump sum out. So either building up capital to do that or overpaying your mortgage or something. So this is where good financial planning comes in. It gives you opportunity, it gives you potential, and it gives you the ability, if you've planned well, to really enjoy that retirement when you get there.
That's good. I appreciate that. Thank you for the insights, George. Thank you so much.
Cheers, John.